If you're even thinking about buying a home, you know the mortgage rate is pretty much everything. But have you ever really stopped to ask, what's going on behind the scenes? What's actually driving that number? Well, it turns out it's a lot more interesting than you might think.
So let's just ask it straight up. Who's calling the shots? Who's the one really in control of the interest rate you're going to get for your home loan?
You know, if you ask most people, the answer you'll probably get is the Fed, right? We see it on the news all the time. The Fed raises rates, the Fed cuts rates, so we naturally assume that our mortgage rates are just going to follow along. But here's the thing. That's not really the whole picture. Not even close. And if you're only watching the Fed, you are absolutely missing the real story. So let's peel back the curtain and see what's actually going on. All right, first things first. We've got to bust this Fed rate myth. We need to get clear on what the Federal Reserve actually does and what it doesn't. So that big rate you always hear about in the headlines, that's the federal funds rate. And here's the key detail everyone misses. It's the rate banks charge each other for overnight loans. Think about that. It's an ultra short-term tool for the banking system, not the 30-year loan you're trying to get for a house. Now, don't get me wrong, the Fed's rate does have a direct hit on some things. It definitely impacts loans that have variable or short-term rates. We're talking about things like home equity lines of credit, HELOCs, or adjustable rate mortgages, ARMs. Because their rates reset all the time, they are way more sensitive to what the Fed is doing day to day. But for that big 30-year fixed mortgage, the relationship is way more complicated. It's like a complex dance. The market is always trying to guess what the Fed's going to do next, and sometimes the market just leads the dance itself, reacting to economic news before the Fed even makes a move. It's this constant push and pull. So if the Fed isn't really leading this dance, then who is? Well, it's time to introduce the real star of the show when it comes to your mortgage rate. Okay, so if we've established the Fed isn't the one directly pulling the strings on that 30-year fixed loan, what on earth should we be looking at instead? It all comes down to this one thing, right here, the yield on the 10-year Treasury note. This is the real benchmark. For the most part, 30-year fixed mortgage rates follow this thing almost in perfect lockstep. And why? Because that Treasury yield is basically the market's long-term bet on the economy. And check this out. Here's how it all connects. It's a chain reaction. And notice what's at the beginning. It's not the Fed. It starts with economic data, say a big jobs report or a new inflation number. That data shifts how investors feel, which immediately moves the 10-year Treasury yield, and then, and only then, do mortgage rates follow suit. But hold on. You've probably noticed that your mortgage rate is always higher than that Treasury yield. So what gives? Well, that gap has a name. It's called the spread. It's basically the markup that lenders add on top of that baseline Treasury rate to cover their risk and, of course, to make a profit. And paying attention to this spread is absolutely crucial right now. For years, it was pretty stable, hanging out between 1.5% to 2%. But lately, it has ballooned up to almost 3%. This is a huge reason why mortgages have felt so expensive, even when Treasuries dip. Lenders are just pricing in more risk. Okay, so that's all the mechanics. Let's make it real. How is all of this playing out in the market right now, as we speak? So, here are the numbers. As of early September 2025, the national average for a 30-year fixed mortgage is sitting at 6.44%. And here's the kicker. That's actually an 11-month low. And guess why? Not because of the Fed, but because a weak jobs report came out, spooked the market, and pulled Treasury yields down with it. See the chain reaction? And just for comparison, if you're looking at a shorter 15-year loan, you're seeing that number come down to about 5.64%. Now, it's a completely different universe if we're talking about commercial property. It's not even the same sport. While your typical home mortgage is in a pretty tight range, commercial loans, my gosh, they can be anywhere from 5% to over 14%. That massive difference all comes down to much higher risk and just way, way more complex deals. So that's the snapshot of today. But the real billion-dollar question for anyone hoping to buy a property is, where do we go from here? What's next? Well, the phrase you're going to hear over and over from the experts is higher for longer. Yeah, even with that recent dip we saw, the general consensus is that rates are probably going to stay pretty elevated for the rest of 2025. A lot of the early, more optimistic predictions just haven't panned out. So after all of that,
what does this actually mean for you, the person trying to get a loan? Let's boil this down to what you really need to know. Okay, here's your game plan. First, and most importantly, stop obsessing over the Fed. Start watching the big economic reports like jobs and inflation, because that's what the market is watching. Second, remember the Treasury yield is just the floor. That spread is where the action is. Which leads to number 3, shop around. With that spread being so wide, there are real savings to be had by comparing lenders. And finally, just appreciate that this whole thing is a forward-looking dance. And now, you know the steps.
Which brings us right back to where we started. In a market this dynamic, a market driven by data, and by that intricate dance between investors, I'll just leave you with this question to think about. Is just watching the Fed really enough?